Hello and welcome to another tutorial video. This time around, we're going to be discussing the revenue model for commercial banks and specifically how you project loans for these companies. This tutorial is based on a question that actually came in quite a long time ago, but I want to go back to it because it seems particularly appropriate given some of the new courses and new material we're working on right now. So here's the question. I think you should provide more detail on how to project a bank's revenue. You're just assuming simple growth rates for its loans and a simple interest rate. But what drives the loan growth and where do we get these numbers from? So this particular student was commenting on an older version of an operating model, a three-statement model that we had for a commercial bank and how we projected its interest income and its revenue, which for a bank come from its loans and then the interest that it earns on those loans. So my response to him was that first off, yes, he's correct. We probably should have given more detail, but this was an early version of the model on an earlier version of the site, and we tended not to go into quite as much detail back then. And so we took his suggestion into account, and we created a new version of the course that goes into a lot more detail on loan growth and the other variables that impact revenue for a commercial bank. So to explain where these numbers come from and the key drivers behind loan growth and revenue, I'm going to use a few examples based on Shawbrook, which is a relatively new bank in the UK that we ended up using in the new course for the main case study there. Before we get into that though, I have to give you a little bit of background on how to think about revenue projections for commercial banks. So with normal companies, you can usually separate revenue into a few variables. For retail companies, it might be the number of stores they have times the average sales per store, or the number of square feet they have times the sales per square foot. With pharmaceutical companies, it might be the number of drugs or the number of patients they have times the average annual amount each patient pays or something like that. For commercial banks, the majority of the revenue is going to come from something called net interest income. And I've pasted in the finished model or part of the finished model that we have for Shawbrook here. And you can see that well over 90% of their revenue down here consists of the net interest income. Now, they do have other segments. They do have operating leases, they have fees and commissions, but the vast majority of what they're earning comes from the interest they're earning on their loans minus the interest expense they're paying on their deposits and other funding sources. So net interest income, as I just said, consists of the interest income earned on loans minus the interest expense paid on deposits, debt, and other funding sources. So the key component to revenue, number one, is loans and deposits. You have to know what loans and deposits are going to be, or else you cannot possibly estimate something like net interest income. And then key component number two is what the interest rates will be. So how much is the bank earning on its loans and how much is it paying out on its deposits and debt and those other funding sources? Now, interest rates are a whole separate topic and we don't really have time to get into them in this lesson, but we may cover them in the future. I'm going to focus on loans here and loan growth. And if you're wondering about deposits and even other funding sources like debt tend to be linked to loans in some way. Typically in models, you will link these and you will assume that deposits represent some percentage of loans, and even something like debt and preferred stock and mezzanine and subordinated notes may represent some percentage of loans as well. So if you think about just that first component, the loan growth for commercial banks, more so than with normal companies, commercial banks' fortunes are very heavily tied to the overall economy. And what I mean by this is that if you have higher GDP growth, GDP, the gross domestic product of the country, a measure of the overall economic activity, if you have higher GDP growth and the economy is growing more quickly, you're going to have more transactions. So more buying and selling. And as a result, more people and more businesses are going to need to borrow money from banks. Consumers, people will need to borrow money to buy more things, to buy houses, to buy cars, and businesses will need to borrow more money to meet that expanded demand and to be able to manufacture, sell, and deliver products and services that consumers are looking for. A healthy bank will tend to grow its loans more quickly than the GDP growth rate because credit expansion tends to lead economic expansion. Now, this wasn't always true. Back before 1971, when countries were still following the gold standard, money and credit were sort of different things. But ever since that went away, essentially they are the same thing. And credit, ever since then, has been growing more quickly than the overall economy. And in pretty much all countries out there, the amount of credit far exceeds the GDP in the country. So the first key driver here is just the GDP growth of the bank's country or region. Of course, it's not quite the whole story, because loan growth may or may not trend with GDP growth. Usually there's going to be some type of correlation, but it's not quite accurate to say that, for example, if GDP is growing at 3% and loans have been growing at 5%, then they're going to keep growing at 5% as long as the GDP growth stays at around 3%. And the reason it's not quite accurate is because some banks may perform better or worse than others. For example, let's say that mortgages are expanding rapidly because GDP growth is up, employment is up, and more people are buying homes. If this is true, will two banks that both operate in the mortgage market grow their mortgages at the same rate? And the answer is no, of course not, because one bank might offer more favorable terms and therefore gain more customers. One bank might have a more effective sales force. One bank might have different lending standards. So one bank might be very stringent. It might not approve that many people, but another bank might have much looser standards and approve far more loan applications. So market share is the second key driver for loan growth. And if you put those two together, the GDP growth rate and then the bank's market share in its individual lending segments, you can usually come up with an estimate of how quickly it's going to grow its loan book. So when we project loan growth, you can think of it as a 5-step process. Step 1 in the process is to size each of the bank's markets. So if it operates in mortgages, auto loans, and credit cards, you have to get some outside data to size those markets and calculate the bank's market share. In step 2, you can make each of those markets a percentage of the country's GDP. So you look at it on a historical basis and you see, roughly speaking, as the GDP has grown, how have these markets changed? So if auto loans represented 10% of the GDP in past years, how has that changed over time? Is it up to 11% now? Is it down to 9%? Those are the types of questions you want to look at. Then in step 3, you project how the country or region's GDP will change in the future. In step 4, you project the bank's market share in the future. And then in step 5, you finish off by calculating the loan size in each segment. You take the GDP, you multiply it by the loan market size as a percent of the GDP, and then you multiply it by the bank's share in that particular market. Let's go through each of these steps one by one and go into some more detail and show you how to actually do them in Excel and consult with outside data sources to get the information. So I'm combining steps 1 and 2 here because they're really part of the same process, which is sizing the loan markets. You're somewhat limited here by the available data because you can easily find the total amount of mortgages in a developed market like the US or UK. But if you go to Ghana or the Central African Republic or some other smaller country, it's going to be much harder to find this. You can look in a lot of different sources. And for Shawbrook, they operate in mortgages, asset finance, business credit, secured lending, and consumer lending. And to get the addressable loan markets by segment and to estimate the size, we look in a variety of different sources. You can look in industry reports. This one is by this company, or actually a university, De Montfort University. So they actually give estimates here for the total amount of outstanding property loans. That would be one source. Shawbrook also recently went public when we did this case study. So in their IPO prospectus, they also give estimates for the total addressable market size and then the total market that they have that they can address across all their different business segments. So that's another source. And then in their filings, of course, they also give the actual loan balances in each of their segments. And they break it up a couple different ways according to impaired loans versus non-impaired loans. But the important thing is to get the total in each segment. So that's where we can get a lot of the information here from. And then based on that, we can do a couple of things. We can look at their market share by segment. So we just take their amount of loans and then we divide by the total addressable market that they disclosed in their filings or that we found in outside sources. Now, if you can't find this type of information because it doesn't exist or you're in a much smaller country or something like that, you can make it less granular. Just look at the total amount of loans instead. And then instead of doing it on a segment by segment basis, just calculate the bank's market share out of all the loans in the country and make the total loans a percent of GDP instead. So there's always a solution, even if you can't find all the exact numbers. Make it less granular. If you can't find anything on even the total amount of loans in the country, then maybe you have to just use simple percentage growth rates like we did in our older model. But whatever it is, you can usually find some way of estimating this. And the goal overall is to get a rough sense of whether the bank's market share is rising or declining. Because if it is rising, then as the GDP grows, the bank's going to benefit even more. If it's declining, it is not going to benefit as much, even if the GDP is rising and the economy is doing well overall. Now in step 3, where we project GDP growth, you have to start by finding the country's nominal GDP. In this model, for example, we start with the United Kingdom nominal GDP, and you can easily find these figures on Wikipedia. You can go to the government website, and usually the Department of Economics or Statistics or Labor or something like that will have these numbers. We can also look in other sources like Statista, which is a site that gathers a lot of useful statistics on the economy, finance, deals, other things like that, and they give us estimates for the growth rates. Once you have those estimates for the historical rates, you have to project it going forward. And typically in bank models, you will look at different cases and see what happens if their growth continues as is, if it goes higher than expected, and then also if it goes negative and lower than expected, and then there's some type of recovery. So you like to look at scenarios where there is a recession and a recovery, where there is relatively low growth, and then when there is higher than expected growth. So in our model for Shawbrook, we do just that. And we look at a base case where the UK GDP grows by about 2.5% to 2%. The upside case is 3% to 3.5%. And then the downside case has low to flat growth, followed by negative growth in 2 years, so a recession for 2 years, followed by a modest recovery after that. Now, for the actual numbers, again, you have to look at some of the sources I mentioned here. The IMF and World Bank will sometimes have projections for individual countries, but I would encourage you not to worry about this too much because in most cases it doesn't really matter. Most developed countries are growing around 2 to 3% or even less than that sometimes. If you're in an emerging market, yes, you'll have to think about this in more detail, but for a lot of countries out there, growth rates are so low that it doesn't really matter that much. So here, for example, at this point, we could now take the UK GDP and then we could multiply by 1 plus the nominal GDP growth rate right here. And then we can copy this across. Now, step 4, to project the future market share. There are 3 different approaches you could use here. First off, you could just look at historical trends and then extend them. So if the bank is losing market share, maybe they keep losing market share and you extend that. If they're gaining market share, you might do the opposite. And if it's not changing much, maybe you keep it about the same. So here, for example, we can look at both the addressable lending market sizes as percentages of nominal GDP and then the market share. I didn't really cover this one, but this is another step in the process. For the lending market share, we can see that across the board, they're clearly gaining share in commercial mortgages going from 0.01% to 0.27%. And we sort of just extend that trend and take it from 0.4% to 0.8% over 5 years. And then for the others, we do something similar. Asset finance goes from 0.78% to 1.02%. We extend it and make it go up to 1.35% over 5 years. And then secured lending, we have it increase from about 7% to 15 or 16%. Consumer lending is at 0.66%, up from 0.01%, and we make it go to 1.2%. So that's one approach. Another approach is to speak with people in the market, real estate brokers, new homeowners, people like that who are familiar with lending standards and what's going on. And we actually do that as well. As part of this case study, we went around and spoke with people in the market, and we actually got estimates for market share from many of those. People saying or making comments like Shawbrook's market share may not go above 1% anytime soon, at least for a certain segment of the mortgage market. And then other people might explain how they actually pick the lender they go with if they're looking for asset finance loans, for example. So you can look at a lot of these types of comments as well and get a general sense of what's going on. And then finally, you can also look at outside sources like equity research and buy-side research and see what they're saying about the company. We didn't really use that here because we had good data from other sources and we had reasonable trends from historical numbers, but we could have certainly done this as well. Now in step 5, you need to calculate the loan size in each segment and wrap up this calculation. This is actually pretty easy because you just take the nominal GDP, you multiply by loan market size as a percent of GDP, and then you multiply by the bank's market share. So here's how we put things together and do this in Excel. We have our estimates for the addressable loan market sizes here and then Shawbrook's market share. So let's go up and first start by calculating the addressable loan markets by segment. So we'll take the percentages down here and then we'll multiply by the UK GDP and anchor the row part of that so it doesn't shift around. We'll copy this around and then sum up all these numbers. And we can see the progression here up to a slightly higher total addressable market size. And then once we have that, we can go up here and for each of these, we can take the total addressable loan market and then multiply by Shawbrook's market share down here. We also have to multiply by units to convert this to the proper figure. We can see that right there. And then we can do the same thing going down. So we can do the same thing for asset finance, multiply by that percentage and multiply by units. And then for business credit, we can take this number and multiply by the business credit percentage and then multiply by units. And then for secured lending, let's take our number and multiply by the percentage and then multiply by units. And then for consumer lending, let's take the number here, multiply by the percentage, and then multiply by units once again. So we have that. And then we can copy this across. And we can also copy across our percentages for the growth rates here. And we have that set up and in place. So that's how we go through the process. Now, the calculation part is actually the easiest one, but what's harder is to check your numbers afterward and see if the estimates seem reasonable. Do they reflect accurately the different outcomes that are possible, or are they too slanted in one direction or the other? Oftentimes, you want the base or upside case to reflect equity research or consensus estimates or management estimates, and then you really want the downside case to be a true downside case. You don't want to say, in the upside case, growth is 3%, the base case, growth is 2%, and the downside case, growth is 1%. It's not wrong, but it doesn't really represent what happens in a true recession. In a true recession, GDP growth turns negative, and you want to reflect that somewhere here in at least 1 year so you have an accurate idea of what could happen if there is a recession in coming years. So here, for example, if we change it to the upside case, we can see that the loan growth is much higher. It starts at around 37% and declines to 15% over time. And then if we change it to the downside case, loan growth continues, but the rates slow down, especially in the first 2 years. And then they pick up a little bit after that when there's a recovery and GDP growth finally turns positive in years 4 and 5. Now, we don't have anything in particular to check these against, but if you go into equity research, for example, we could take a look at this. And this Barclays report has loan projections for the company. They're saying by 2017, they'll have about 4.7 billion pounds in loans. If we check our number, we have about 4.1 or 4.2 billion, but in the upside case, we actually exceed their number. We get to around 5 or 5.1 billion. So this doesn't necessarily mean that we're wrong or that they're right or the opposite. It just means that roughly speaking, we are in alignment with their numbers, at least in the upside case, we're a little bit above them. The base case, we're below them, but we're not getting something that's wildly off the mark. We're not getting 10 billion of loans when they only have 4 or 5 billion, for example. So those are the types of things you want to check for at the end. Of course, we need the rest of the model to complete this fully. So I have up here the finished operating model for Shawbrook with everything else, including their financial statements. And really what you typically do here is wait to finish the whole model and then go back and start checking your working parts like this. But this would just be one step of the process as we begin doing that. So let's do a recap and summary now. Revenue for banks is highly dependent on loans, deposits, and interest rates, and of course other funding sources and other types of securities the bank is earning interest on. But for pure play commercial banks, it tends to be mostly about loans and deposits. Loan growth is tied to GDP growth and the bank's market share in each segment, or overall market share if that's all you have. Steps 1 and 2 of the process to project loans for a bank include sizing the bank's addressable lending markets and then making each market a percent of the GDP of the bank's country or region. Then in steps 3 and 4, you project the GDP growth and also how the addressable lending market relative to GDP changes over time and the bank's market share in each segment. You factor in different scenarios if you can do so. Then in step 5, you calculate the loan size in each segment and check the numbers against other sources. So that's a little bit about how you project loan growth for a bank and how you think about its loan portfolio. Hopefully now you have a better grasp on how this works for commercial banks and also what you can do if you don't have the level and detail of information that we happen to have here.